Comparing 10-year Treasury versus S&P 500. Income off the 10-year, dividends off the S&P 500. We're actually using the 10-year Treasury as a proxy for the 30-year. We don't have enough data for the 30-year Treasury, by the way, so we're going to use that as our proxy. It's all pretty doggone close. I mean, there's a little bit of difference in the 10-year versus 30-year over time. In fact, they got rid of the 30 years for a while under George W. Bush. They're back now. In fact, I would imagine we're probably going to get 40 and 50-year bonds, even perpetual bonds as we go forward for funding sources. But be that as it may, it's going to be fun. So what we're going to do, I've been spending all morning on this, my friends. And look at my notes, all kinds of notes. This is what I do when I do my videos on these spreadsheets. I just write stuff down, take all kinds of notes. Pablo and I, notes after notes after notes. In fact, this is one thing I've been working on. The 36 questions you need to answer before you retire. There'll be another book. I got all this in my head. I just end up doing the videos. I hope you don't mind my beard. I'm trying to see if it looks white. Does it grow out white like Santa Claus? Yeah, we'll see. All right, so let's dive into this. What I'm doing is I'm using the 10-year Treasury as our proxy for the 30-year. And the reason for that, we don't have enough data going back long enough in the 30-year. Using the Robert Shiller stuff at Yale, we do have the 10-year. All right, so that's what we're using. We're using a 10-year Treasury bond to give us a proxy for interest rates going back in time, all right, in our old time machine. Then we're going to political calculations, which actually extrapolates the Robert Shiller data and puts it into their S&P 500 at your fingertip, which is friggin' fantastic. The problem with the Shiller stuff is month by month by month. And trust me, I've been sitting here all morning. It's now, 2 o'clock, 1:52. I've been doing this since 7 in the morning. I mean, shoot, probably even before that. It takes a lot of time to get this done. But once you get it done in your spreadsheet, woohoo, it's golden because you don't ever have to do it again. You just got to update it, which is what Shiller did. Anyway, so we're using the data from here, which gives us an index price at a certain date, the dividends that paid on a certain date, and so on and so on. And then all I'm doing is I'm just extrapolating that, put it on my piece of paper here, then I'm going in and cut and paste, boom, 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 boom. And what we're going to do is we're going to take 4 scenarios comparing the two, comparing the bonds. All right, we're going to compare the income off the bonds versus the maturity and the maturity value off the bond versus the income off the dividends versus the end of the 30-year time frame. When I was at Schwab, something Schwab always said was, you just retired, you're still a long-term investor unless you think you're going to die in the next couple of years, because most investors think they're going to last another 25 or 35 years. Thus, you're a long-term investor. You have a long-term time horizon. I always thought that was incredibly informative, actually, to look at. If you're 60, 65, you're investing, you're not going all bonds, man, because you're a long-term investor. And then we're going to say, what happens when we take income from a bond, guaranteed, safe, relative to income from dividends, which are growing but are not guaranteed, are not safe? What happens? That's the ultimate thing we're going to find out. From a bond perspective, how much income are we going to get over 30 years? From a dividend perspective, typically you're going to get less dividends on the front end. How much income you're going to get off of 30 years in that regard? And then what's the net value of both after 30 years? I find this to be incredibly interesting. All right, so we're going to take those two. Now, in another video, I'll put it in the easy to see charts, but I'm just fired up on this. Now, what we're going to do is we're going to do a deflationary time, 1871 and 1900, and I'll show you what I'm talking about there. If we look at the deflation, we had 6.87, negative 5, negative 3.1, negative 2.73, negative 4.76. What that simply means, my friends, is in the first 30 years of our scenario, which is exactly what we're using, we only had positive inflation 2 years of the first 30. It's nuts. So we're going to do deflation. We're going to do inflationary time, which is this 1960s that started off, 66 to be specific. We're going to use where we had high interest rates on the bonds and quite low dividend yields. And then we're going to use where we had low interest rates on the bonds and relatively high dividend yields. And we're going to compare all 4 scenarios to see which one shakes out. This could be great. All right, so again, we're looking at 1871. So to give an example, in 1871, the 10-year Treasury is paying 5.32%. You're going to invest $100,000 in the 10-year Treasury. You're getting 5.32%, which means you're getting $5,320. Hope no one disagrees with that. If you invest $100,000 at 5.32%, you are inherently getting $5,320. But Josh, to have $100,000 in 1871, you'd have to be a Rockefeller. It's percentages, my friends. The amount that you're starting with matters not. It's all percentages. How much did X amount pay you over the course of a certain amount of time. And as long as you're comparing the two similar things, that's all that matters. So if you want to use 10 million, if you want to use $100, I don't care. It's total percentages. How much did it pay you relative to the starting value? If you figure you should use $10 as opposed to $100,000, just divide, what's that, by 1,000, right? No, but divide by, I don't even know, 10,000. Divide what we come up with by 10,000. That'll give you your ending results. It's fine. It's the exact same thing. Because a pure dollar doesn't matter. It's actually the percentages that it's doing. All right, so back then in 1871, the S&P 500 only traded, and it wasn't really the S&P 500 back then. I think it was like the Dow 60 or S&P, I don't even know what it was. But whatever, it's the market essentially paid 4.44. That was the share price, $4.44. Had a dividend, it paid 26 cents a dividend, which means had a dividend yield of 5.86. You take E4, which the dividend, that the actual dollar amount, in this case 26 cents, divide by the price, and you had a yield of 5.86. Simple being, if you had $100,000 invested in this, you'd have a dividend payout of $5,856. We're not reinvesting anything here, my friends. It's all you. Use that money to light your cigars at $100 bills or to dive in it like gold coins like Scrooge McDuck. Some of the young guys might not know who Scrooge McDuck is. But I am calculating the number of shares we need. And the reason I'm going to show why that later on. But so basically, in order to get $100,000, we need 22,522 shares because it takes $4.44 is one share. Well, we divide that by $100,000, which means we need 22,522 times the 4.44. That gives us $100,000 starting value. Remember, you're going to your broker, your friendly broker, saying, I want $100,000 of S&P 500. The guy's saying they cost $4.44 right now, which will give you 22,522 shares. And that doesn't make sense, and it doesn't mean anything initially, but it will later on. Again, all right, so I hope that makes sense. So let's go show you what it looks like. Now, real quick, actually, just want to show you something. If we look historically, going back to 2020, the historic 10-year, or the average, 10-year Treasury bond has paid 4.52% historically. Right now it's 0.9. Historically, the S&P 500 has yielded 4.32%. Right now it's less than 2. You can show you the low interest rates that we are dealing right now. It's nuts, man. It is nuts. All right. So a deflationary time. I already talked about the deflation of the 1870s going on to the beginning of the 20th century. On the bond, you got 5,320. Well, you got that each and every year because you're literally locking in this price, the 5.32% interest rate. You're locking in that for the next 30 years. We're using the 10-year as our proxy, just FYI, which means you did not have 4,590. You did not have 4,450. You did not have 3,600. You did not have 3,400, 3,100. So in some ways, we're making the bonds look better than we're making than it was because you're getting more because you locked it in. Now the dividend yield, on the other hand, it did drop. It went from 5,856, or the actual dividend amount, to 4,054. Went back up to 7,200. Then it went back down to 4,955. Went to 4,730. Went to 4,054. So at the end of 1990, you're only getting $4,955 on dividends, but you're getting still 5,320 on the bond. So when all was said and done, you got 168,000 in total dividends. You got 159,000 in total income from the bonds. We're not looking at taxes. We're not looking at nothing. We're not reinvesting. And remember, you can't reinvest in bonds. You just can't. So stop. If you reinvest, you can't reinvest. You can reinvest in other bonds, but you can't reinvest in the bond you previously bought. So pretty similar here, even Steven, when it comes to income. But we know that the bond matures at $100,000. The S&P 500, well, we had 137,000. Why? Because we had these 22,522 shares times the ending value at the 1900, which was 1900 right there, $6.10 is the ending value of the S&P 500. So we take those two numbers, which if you do ourselves, we're going to times the number of shares by the ending value. That means we had $137,000. So in this case, when all said and done, we had $259,000 in income and maturing value of the bond of the 10-year Treasury. We had $137,000 plus $168,000 of income, we had $305,000 on the S&P 500. So even though the deflationary hurt us from the S&P 500 in income, because we weren't making a rising dividend. I mean, again, we started with 5,800 and we ended with 40. What was it here? We were down to 4,054 at one point, and we ended with 4,900. Where the lease of bond paid a consistent 5,320. Let me make this a little bit bigger. All right, so I hope that makes sense. That work? All right, so let's go now. That's deflation. So in deflation, the S&P 500 beat the 2,059 was better. We had 46,000 net worth more in the S&P 500 than we had in the bonds in a deflationary time. And my friends, we're never going to get deflation like that again. We might not get inflation like we're going to show you here, but we're never going to get deflation like that again. And when I say never, I don't know. The 10-year Treasury in 1966 was yielding 4.6, so that's a $4,610 of what you got for every $100,000 you had in there. The dividend yield in 1966 on the S&P 500 was, go to 1966, was right here, 2.94. So you can see the S&P 500 was significantly lower than the dividends and the interest that you're getting on the 10-year Treasury, again, the proxy for the 30-year. So if we go back to here, we go to, I want to go to high inflation. Bear with me just a second. We go to right there, inflation. So we're getting $2,936 on the S&P 500, but we're getting $4,610. But we've locked in that $4,610 on the bonds. We locked it in because we're scared. We're scared of the market. The communists are coming. JFK, Lyndon B. Johnson, whoever you're worried about. The Democratic Convention, whatever. So we're locking in that for $4,610 for 30 years, which is significantly more than the dividend we were receiving off the S&P 500. But let's fast forward until 1995 after 30 years. After 30 years, the dividend off the S&P 500 was almost about 3 times that of the income that we're getting on the 10-year Treasury. The 10-year Treasury, again, 30-year Treasury is paying $4,610. And the income off the S&P 500 was $14,123. So we got $211,000 in total income from the S&P 500. We only got $138,000 of total income from the bond, the 10-year Treasury, the 30-year Treasury. At the end of the day, the S&P 500 was worth $498,000. So $498 plus the $211 we received was $710,000 minus the $238, so basically it's $470,000 more than the 10-year Treasury, because the 10-year Treasury paid us $138,000 of income, but we only got $100,000 at maturity. That's a no-brainer there. So in this case, high inflation, the bonds are horrible. In fact, if we look at in 1966, we were paying 4.6%. Let's look at what that bond was paying in 1996. When it matured in 1995, we had to revest it. I don't remember what it was doing, 5.65, so not much more. About 10%, 1 percentage point more, but not much. The interesting thing, the S&P 500 dividend was only 2.26 at that point, whereas the S&P 500 dividend when we took it out in 1966 was also 2.94. So the dividend hasn't changed much either. It's just a number. Is just the actual dividend amount, not the dividend yield, but the actual dividend amount. So if we go back to 1966 and look at the dividend amount, which is E, 1966, we had $2.74 a share, and we go to 1995, it ended with $13.18 a share. So the dividend yield, or the actual dividend increased by 500%. 5 times, and that's the benefit of the rising dividends. All right, so let's keep going. Let's go to a high interest. So this is in 1990 during the Saddam Hussein thing, where everyone's like freaking out. And I remember this like it was yesterday. I was in the army. We're fighting the elite Iraqi Revolutionary Guard. Oh no, we're all gonna die. So interest rates are through the roof. Bonds are the oil was through the roof. We're all gonna die. So at that point, we only had 3.27% dividend yield, but we had 8.2% interest rate on the 10-year Treasury. 8.2. So we do this until 2009. How much did the 10-year Treasury pay us? $246,000 of total income until 2019, excuse me. you received $246,000, which is $30,000, $35,000 more than you received in the dividends on the S&P 500 because you locked in a high interest rate. You locked in 8.2. I mean, you're like, I'm locking that sucker in. This is great. And when that matured 30 years later, you received $246,000 of income. On the S&P 500, you only received $209,000 of income. That's it. I mean, you were literally starting at $327 or $3,277. You don't approach that of the 10-year Treasury until right there, 2013. It took you 23 years before you got on par with the 10-year Treasury in terms of the income you're receiving. But now we're getting $16,000 of income off the dividends, and you're only getting $8,210 off the 10-year Treasury, but you're not getting $8,210 now because that bond has matured, and now you're getting 0.9. Where the dividends on the S&P 500 are paying $16,000, $17,000 because, again, what started as an actual dividend in 1990, let's go back, you were getting $11.14 per share, even though it was only 3.2% dividend yield. But at the end of 2019, you're getting $54 per share, even though, again, it's only 2.08% yield. You got to stop this word about the dividend yield. The dividend yield is irrelevant. As long as it's growing, that's what matters. All right, lastly, let's go with the low interest rate. So 1940, the interest rates are low. I'm not sure. I mean, obviously, as the start of the war, right after the Depression, I mean, they're low. Let's just put it that way. The dividends were twice that. All right, so the dividends are much higher than the interest rates on the bonds. Anyway, so if you go down, 2,210 is all you're getting on that proxy bond. The S&P 500, on the other hand, is paying you 5,000. So if you go down 30 years, we made 300, and this will be the next 30 years. So from 1940 to 1969, we made $380,000 on dividends from that 1940 to 1969. The 10-year Treasury proxy only got $66,000. So we made $320,000 more in income alone. On top of that, the S&P 500 value was $829,000. The value of the 10-year Treasury proxy was $100,000. So we made 380 plus 830 minus 66 minus 100. We made 380 plus 830 minus 66 minus 100. We made $1.04 million more than the bonds did. And just, it's not even just that, but look, we are getting $25,000 a year of income in the last year. On the bond, you're getting $2,200, but now in 1970, the bonds are higher because higher inflation. So let's take a look. 1970, you trade that bond in for 7.79%. So now, I don't want to, underserve this. So now you're getting, instead of getting 2,200, you're getting 7,590. But the S&P 500 is paying you triple that. It's insane to me. I mean, you're going to get 25,000, 27, 28,000 this year because you're getting, again, at the end of, the end of 1995. So the start of 1940, you got 62 cents a share in dividends. At the end of 1990, was it 1960? No, 1969, you got $3 a share in dividends. It's nuts, man. Was it 1969? Was it? Yeah, 1969. You got $3 a share in dividends at the end of 1969, where you only got 61 cents before that or whatever it was. It's crazy. Almost okay. Mailman just making sure Pablo doesn't go crazy. So, man, I'll let you make that decision for you. It's just, I think you're nuts to buy the bonds relative to the S&P 500 index. I just think you are. Now, again, every circumstance is different, but if we want income, we have to have a rising. The only way we have rising income is not by dividend yield, it's by increasing dividends that the companies pay. Now, if you want to look at something, let me just show you real quick, then wind this down. E is the dividend, not the dividend yield, the dividends they're actually paying. I don't care about the yield. So here we go. We're paying 2000 and right here. 2009, they paid $28 a share in dividends, but then in 2010, it went down to 22. All right. So that's a pretty big chunk. That's $6 divided by 28, that's a 21% decrease in dividend yield. Where that, on the 10-year Treasury, if you had locked it in, you didn't get any decrease. That's the risk. There are some times the dividends do drop. I don't even think that's worth even spilling ink about. I just think it's nuts. Anyway, hope you find this helpful. Love to hear your comments on this. I'm going to do some more with some nice charts and stuff like that, and I think it'll be pretty cool. You'll get a lot of that. The visual always helps me, and I'll do more visuals on this as I work my way around this. Hey, thanks, guys.